And this week, mortgage rates hit their highest levels in more than 20 years, breaking records as they reached 7.09% for a 30-year fixed mortgage. Some sources even reported rates over 7.5%. What's behind this disparity? Mortgage rates are more complex than the headline number suggests. The note rate is what we typically hear about, which dictates the interest paid with each mortgage payment. However, it doesn't account for all interest that borrowers pay, especially when considering prepaid finance charges, essentially interest paid upfront in the form of closing costs. But sometimes, mortgages come with lender-paid closing costs, or a closing cost credit from a builder. While it may seem like a great deal, it's essential to remember that nothing comes for free. Whether it's the borrower or the lender, the same amount of money will be paid to the same parties. The difference lies in the interest rate. A higher rate allows a lender to cover more upfront costs. This explains how a rate of 7.09% can be equivalent to 7.5%, depending on who's paying the closing costs. Now, how are higher rates affecting mortgage quotes? In a stable rate environment, higher rates would linearly translate to a lender's ability to cover more of your upfront costs. But we're not in a stable environment. At times, a higher note rate could even decrease the amount of upfront costs a lender can pay. This brings us to a technical point. The value of a mortgage loan, whether sold or not, is determined by the interest rate. Generally, a higher rate makes a loan more valuable as it collects more interest over time. The mortgage needs to last long enough for the extra interest to be collected. If rates suddenly drop and you refinance, the lender loses that extra interest and their investment in your upfront costs. Currently, many loans come with higher upfront costs, partly due to fees imposed by Fannie and Freddie. Sometimes, lenders can't offer a higher rate with lower closing costs due to these fees and market instability. In these situations, borrowers may have to pay higher closing costs than expected. So, what's next? We need to return to a stable mortgage market. We explored the big picture structural issues with rates last week, linked to the commentary. In the coming week, we'll discuss the outlook for the rest of the year and beyond.